Why the stock market makes rich people richer. The stock market has long been a symbol of wealth and financial growth, often portrayed as the cornerstone of the economic success of the wealthy. While it can indeed be a tool for anyone to grow their wealth, the reality is that the stock market disproportionately benefits the rich. This article explores the reasons behind this dynamic, highlighting the structural, economic, and behavioral factors that enable the wealthy to amass even greater fortunes through the stock market. 1. Access to capital. One of the primary reasons the stock market benefits the wealthy more than the average person is access to capital. The rich have significantly more disposable income to invest compared to the middle class or the poor. This gives them the ability to buy larger quantities of stocks and diversify their portfolios effectively, reducing risk while maximizing potential returns. Example: a person with $1 million to invest can allocate their funds across multiple asset classes, industries, and geographical regions. This diversification mitigates risk and increases the likelihood of steady returns. In contrast, someone with $1,000 to invest may struggle to achieve the same level of diversification. 2. Compound growth and time. Wealthy individuals often have the luxury of letting their investments grow over long periods, harnessing the power of compound interest. Compounding works best when investments are left untouched, allowing earnings to generate further earnings. Key insight: many wealthy individuals begin investing early, whether through inheritance, education, or financial literacy. For example, a $100,000 investment growing at 8% annually will become over $1 million in 30 years. The longer the time horizon, the more significant the compounding effect, which disproportionately favors those who can afford to keep their money invested. 3. Higher risk tolerance. The rich can afford to take on higher risks because their basic needs and financial security are already met. This ability to take calculated risks allows them to invest in high-return assets like equities, venture capital, or even speculative investments. Contrast: for someone living paycheck to paycheck, the idea of losing money in the stock market can be devastating. This leads to more conservative investment strategies, which, while safer, often yield lower returns over time. 4. Access to information and expertise. The wealthy often have access to advanced financial knowledge, tools, and professional advisors. Hedge funds, private wealth managers, and financial planners provide insights and strategies that are not readily available to the average investor. Insider edge. Wealthy investors can afford premium services like Bloomberg terminals or access to top-tier research reports. They may also participate in exclusive investment opportunities, such as initial public offerings, IPOs, or private equity deals, which offer higher potential returns. 5. Economies of scale. Investing large sums of money often comes with lower fees and better terms. For example, institutional investors and wealthy individuals can negotiate lower management fees with financial advisors or access funds with lower expense ratios. Example: a retail investor might pay a 1% management fee on a $50,000 portfolio, while someone with $10 million invested might pay only 0.25%. Over time, these savings significantly boost net returns. 6. Tax advantages. The tax system in many countries is structured in a way that benefits wealthy investors. Capital gains, dividends, and other investment income are often taxed at lower rates than ordinary income. Additionally, the wealthy have access to strategies to minimize their tax burden. Tax minimization strategies. Capital gains tax. Long-term investments are taxed at lower rates, incentivizing wealth accumulation through the stock market. Tax loss harvesting. Wealthy investors offset capital gains by selling underperforming assets. Retirement accounts. High earners maximize contributions to tax-advantaged accounts like IRAs or 401ks, allowing their investments to grow tax-free or tax-deferred. 7. The snowball effect of wealth. Once a person accumulates substantial wealth, it becomes easier to generate more. This snowball effect is particularly evident in the stock market, where higher capital allows for greater reinvestment and diversification. Example, a wealthy individual can reinvest dividends and capital gains, creating a compounding loop that accelerates wealth growth. Over time, their portfolio grows exponentially, far outpacing the returns achievable by smaller investors. 8. Influence over markets. Wealthy investors and institutions often have the power to influence markets. By deploying large amounts of capital, they can drive prices in their favor. Additionally, their investments in lobbying and policy making can shape regulations and policies that benefit their interests. Case in point, during economic downturns, large investors often have the resources to buy undervalued stocks, positioning themselves for significant gains during the recovery. 9. Behavioral advantages. The wealthy are less likely to make emotional investment decisions, as their financial security is not at stake. This enables them to adhere to long-term strategies and avoid common pitfalls like panic selling. Behavioral traits of wealthy investors: patience to ride out market volatility, discipline to stick to an investment plan, access to advisors who provide objective advice. 10. The role of institutions. Institutional investors like hedge funds, pension funds, and family offices manage large sums of money on behalf of the wealthy. These institutions have significant advantages, including advanced algorithms, insider connections, and the ability to move markets. Why this matters? The average retail investor cannot compete with the resources and expertise of these institutions, further widening the wealth gap. 11. Psychological barriers for average investors. For many people, the stock market seems intimidating or risky. This perception prevents them from participating, leaving them out of the wealth-building opportunities the market provides. Contrast, wealthy individuals, often educated in finance or mentored by professionals, approach the market with confidence and long-term vision. This mindset enables them to take advantage of opportunities that others might shy away from. 12. The feedback loop of wealth. Wealth creates opportunities for more wealth. Successful investments generate income, which can be reinvested. This continuous cycle ensures that the rich grow richer, especially in an environment like the stock market, where growth tends to compound over time. Systemic implications. This dynamic contributes to the widening wealth gap, as those with little to invest are unable to participate in the same cycle of growth. Conclusion: leveling the playing field. While the stock market offers tremendous opportunities, it is clear that the system favors those with existing wealth. However, understanding these dynamics can empower average investors to make smarter decisions. Actionable steps for everyone. Start early. Even small investments grow over time through compounding. Educate yourself. Knowledge reduces fear and enables better decisions. Automate investments. Use tools like index funds and robo-advisors to simplify investing. Focus on long-term growth. Avoid emotional decisions and stick to your plan. By adopting the habits and strategies of wealthy investors, anyone can leverage the stock market to build wealth, even on a smaller scale. While the playing field may not be entirely level, persistence and informed decisions can help bridge the gap.